Valuing commercial real estate is not an easy task, even for the most experienced investors. Commercial real estate deals are generally priced by investors based on the expected returns the property can generate, with investors essentially back solving to a purchase price that would allow them to achieve whatever target returns they set on the deal. However, on that note, one of the hardest parts of commercial real estate valuation is deciding on what those target return values should be based on the specific details of the deal being analyzed and the risk profile of the project as a whole. So to help with creating a framework for return ranges that are commonly used in the commercial real estate industry, and to give you some context around the most commonly measured return metrics that investors are going to have their eye on in the commercial real estate space, in this video we'll walk through 3 of the most heavily scrutinized figures on commercial real estate deals today, the numbers investors are targeting and why, and how you can apply this same thought process to your own acquisition and development opportunities going forward. So when raising equity capital, commercial real estate investors will advertise projected returns on the deal to encourage potential equity partners to invest in the property alongside them. And although actual returns can vary widely from pro forma projections, there are some commonly used targets in the industry that investors are going to be looking for when deciding on whether or not they want to invest in a commercial real estate deal. So while there is no one-size-fits-all answer to the question, what is a good rate of return, there are some industry standards and rules of thumb that investors have come to expect when investing in commercial real estate deals, and that's what we'll walk through in this video. So when talking about commercial real estate returns, there are really 3 main metrics that equity investors care about most when investing in multifamily, office, industrial, or retail deals. And these return metrics are the cash-on-cash return, the equity multiple, and the IRR, or internal rate of return, which each measure different ways that cash is distributed back to equity investors. Now it's important to note that throughout this video, the ranges we'll walk through are on a levered basis, meaning these are returns that are calculated after taking into account any sort of loan proceeds, loan payoffs, or loan payments on the deal. So with that being said, let's get started with the first metric on this list, the internal rate of return, or IRR, which essentially measures the annualized time-weighted return on equity invested in the deal. Now we've gone more in depth on this metric in a previous video on this channel, which I'll link in the description below, but in most cases the projected IRR on the deal is going to fall somewhere between around 7% on the low end up to about 20% on the high end, depending on a few different factors. The first factor, and one we've talked about at length on this channel, is the overall risk the investor is taking on in the deal, which has a direct relationship with the return that investor is going to expect on the project. So for deals with a more significant risk profile, like development deals or major repositioning plays, most equity investors are going to be targeting that higher end of the spectrum, usually somewhere between about 15 and 20%. And this is to make sure that the juice is worth the squeeze, because if investors are taking on a significant amount of risk by investing in a deal, they also want to be compensated for taking on that risk, assuming the deal goes as planned. Now, on the other side of the risk spectrum, deals that are already stabilized or have a minimal repositioning component will generally target an IRR of somewhere between about 7% on the low end up to about 11% on the high end. And because the investor is taking on less risk in these types of deals, they're also generally willing to accept lower returns as a result, essentially trading significant short-term value growth potential for safety and capital preservation. And for everything in between, with a risk profile that involves some sort of value add or repositioning strategy, investors will often be looking for an IRR somewhere in the middle of these 2 ranges, usually around 11% to 15% in most cases, again to make sure they're being compensated for the amount of risk they're taking on by investing in the project. Now, risk is one factor that affects investor IRR targets, but aside from just risk, another factor that's going to directly impact the IRR is the projected hold period of the deal and how quickly capital is going to be returned to equity investors. The IRR is a time value of money calculation, meaning that distributions made earlier on in the hold period are worth more to investors than distributions made later on in the hold period, which can significantly change the IRR figure depending on the projected sale date of the deal. And because of this, for shorter projected hold periods, target IRR figures are usually going to be on the high end of the spectrum, usually somewhere in that 15 to 20% range for hold periods of only 3 to 5 years. And for longer hold periods of 7 to 10 years, because sale proceeds aren't received until significantly later in the analysis, IRR targets for these types of deals generally drop back down into the low teens or high single digits, again, depending on the risk profile of the deal and the timing of the sale. The key thing to keep in mind here is that it's easy to automatically think that a deal is a home run when you see a projected IRR value in the 20 to 30% range, but if those returns represent a short-term hold period, this high IRR value might be artificially inflated due to that quick return of capital to investors, and you may not actually see any sort of significant whole dollar profit on the deal. And to check this and to make sure the IRR is all it's cracked up to be, this leads us to our next metric that equity investors are going to be focusing on, and that is the equity multiple. Now, unlike the internal rate of return, the equity multiple does not factor into account the time value of money, meaning that a $1,000 distribution made 10 years from now is equally as valuable as a $1,000 distribution made in the first year of the hold period for the purposes of this return metric calculation. The equity multiple is calculated by taking the sum total of all investor distributions divided by the sum total of all equity investments, which calculates the entire multiple of equity invested over the entire hold period on the deal. Now, as far as a standard expected range is concerned for this metric, in most cases, for deals with about a 3 to 10 year projected hold period, the target equity multiple is going to fall somewhere between about 1.5x and 3.0x on a levered basis. And even though this metric isn't specifically taking into account the timing of each distribution, because this metric does take into account all cash flows on the deal, the hold period still does have an effect on the equity multiple value, but in a different way than it impacts the IRR. With a longer hold period, this generally results in a larger amount of cash flow from operations distributed over the life of the deal, and because of that, unlike the IRR, the equity multiple on a project is generally going to increase as the projected hold period of the deal increases as well. This also tends to be a great way to cross-check those IRR values that are in the high teens or low 20s with a short-term hold horizon to make sure that that high IRR figure isn't hiding a low or insignificant whole dollar profit number on the deal. So for example, if you have a deal where you'll invest $100,000 and the IRR is projected to be 21.2%, on the surface that might sound good at first glance, but if the deal is planned to be sold in just 6 months for $110,000 and the equity multiple is only 1.1x, you can more clearly see that that IRR value is just one piece of the puzzle and weigh whether or not it's worth going through the time, effort, and transaction costs associated with being involved in a short-term deal like this. Now, aside from the IRR and equity multiple, the third and final metric on this list that's used by equity investors in commercial real estate deals is the cash-on-cash return, which measures the annual cash distribution to equity investors as a percentage of the equity invested in the deal. For example, if an investor invests $100,000 of equity into a deal at acquisition, and then that investor is distributed $10,000 in year one of the hold period, that cash-on-cash return in year one of the analysis would be 10%. And as far as expected return ranges are concerned for the cash-on-cash, this might be the most variable return target of the three we've covered in this video because this metric tends to be so heavily dependent on the business plan of the investor. For ground-up development deals and projects with a heavy repositioning or releasing component, a lack of investor distributions during the construction or redevelopment period is relatively common, which results in a 0% cash-on-cash return. However, for stabilized deals with minor renovations or releasing efforts, most equity investors will be looking for somewhere around a 5% to 8% average cash-on-cash return for most deals throughout the projected hold period. Now, it's important to note here that the average figure is generally referenced in investment materials since the year-to-year value can vary so widely based on quite a few different factors. Loan terms like an interest-only period can prop up cash-on-cash returns temporarily, but these returns will usually see a significant drop once the interest-only period burns off. Increases in net operating income over time can also increase the cash-on-cash return in later years of the hold period, and with loan payments on fixed-rate loans staying constant throughout an entire loan term, this can sometimes result in this cash-on-cash return metric being extremely low in the beginning of the hold period, but significantly higher by the final years of the deal. At the end of the day, for the cash on cash return, the targeted average value is usually going to come down to the business plan of the deal itself, and whether or not that return is acceptable to a given equity investor will depend on the goals of the real estate investment in the first place and the investor's interest in immediate term cash flow versus long-term value growth. Overall, return targets are called targets for a reason, and just because an investor makes a projection on a deal, that doesn't necessarily mean that that project is going to hit those returns. But with that said, these are some basic ranges and rules of thumb I've seen through working at real estate private equity firms and through my own real estate investing experience that can be used as a framework to understand where a project you're considering might fall in that spectrum and whether or not your projections might be too aggressive or conservative based on the returns you're seeing in your model. And speaking of modeling, if you want to learn how to work in and build real estate financial models that measure the IRR, equity multiple, cash on cash, and other metrics to help you make better investment decisions on deals you're analyzing, or to prepare for a technical exam at a real estate private equity or brokerage firm, make sure to check out Break Into CRE Academy, which includes course videos on these topics and other metrics used to analyze commercial real estate deals. You'll get instant access to our library of pre-built acquisition and development models so you can practice what you learn in the coursework, and you'll also have access to one-on-one email-based career support to get your questions answered on your own unique situation if you're navigating the job search process and need some extra help along the way. And if you like this video and want to see more content like this on deal analysis on this channel, make sure to hit the like button to let me know, and let me know in the comments the return targets you generally look for in commercial real estate deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.